Don't look now, but there's something funny going on over there at the bank, George. I've never really seen one, but that's got all the earmarks of being a run.
Why do banks fail? Seems to be a hot topic nowadays with a lot of confusion and fear. So let me help you put it in perspective. Hi, I'm Greg Eident with Elliott International, the largest independent financial and social forecasting firm in the world, and the foremost authority on Elliott Wave analysis. At EWI, our founder and president, Robert Prechter, explained the answer to this question very thoroughly in his New York Times bestseller book, Conquer the Crash. What we're going to do for you today is go through an excerpt of Chapter 16 of Conquer the Crash called How to Find a Safe Bank, where Bob explains the risks in banking. But before I dive in, be sure to like, subscribe, comment, share, and all that. And if you find yourself wanting to learn more about this and how not to only survive but thrive in a deflationary depression, check out the links in this video's description. Okay, so why do banks fail? This is a difficult subject, but you need to understand the risk of systemic bank failures. Let's relate banking to this. Suppose you own title to $50,000 held at a safekeeping institution. Then a neighbor asks you to borrow $40,000 from you on the promise of paying you back $42,000 a year later. You agree. So you go to the safekeeping institution, withdraw $40,000, and give it to your neighbor in exchange for an IOU for $42,000 payable in a year. If someone were to ask you how much money you have in the bank, you would say $10,000, right? Now let's change the scenario to the modern banking system. This time you deposit $50,000 into a bank. Your neighbor calls the bank and asks it for a $40,000 loan, and the bank lends your money to the neighbor. Now, if someone were to ask you how much money you have in the bank, you would say $50,000. How is this possible? The bank is simply a middleman in brokering the loan between you and your neighbor, and taking a fee for doing it, yet somehow you still think you have $50,000. Now, someone might point out that yes, $40,000 is gone from the bank, but the deposits are all pooled, so the first person in the door can always get his money. You could, for example, go to the bank tomorrow and withdraw $50,000. That's true. But everyone in the pool thinks he has the money shown in the bank book, and that is obviously false. Confusion comes about due to a magical word, deposit. This word makes it sound as if you had placed your money in the bank for safekeeping. But what you've actually done, as courts have confirmed, is lend your money to the bank so it can in turn lend your money to your neighbors and split the interest with you. It's a speculative business, not a safekeeping institution. In reality, a bank should not list money on deposit, but money lent to our bank to be paid on demand unless we run short. Loan upon loan escalating through the banking system has created the bulk of the inflation in the system. But this inflation holds up only as long as the loans backing the money listed in the bank books are still good. If all the borrowers were to find that they could not pay back the banks, then the purchasing power that everyone thought they had would evaporate into near nothingness. This outcome seems hard to grasp, so let's go back to the original scenario. Your neighbor calls you up after a year and says, "Sorry, chum, but I invested the money and I lost it. I can't pay you back." Okay, so how much money do you have in the bank? Answer: you still have $10,000, but you already knew your balance, so it's no big surprise. In the modern banking world, if all borrowers were to default, banks would have to admit to having little money on hand. Most depositors would be upset to discover that for every dollar they thought they had in the bank, they in fact only had a few cents. Contrast this outcome with the case of the direct loan. In that situation, the lender knew the score every step of the way. You took the risk with your neighbor and it didn't pay off. Those are the breaks. In the modern banking system, almost no one knows the score because the word deposit is borderline fraudulent and implying a safekeeping role on the part of the bank. Even those who do understand the situation from having seen It's a Wonderful Life a dozen times rarely worry because Congress, by creating the Fed as a lender and the FDIC as a supposed insurer, support the illusion that no losses are possible. This is a system with massive systemic risk, which means in effect that huge illusions can melt away in a flash if the system fails. In our opinion, the modern banking system has no chance but to fail. Its very design in fostering the illusion of riskless lending ensures that ultimately a huge portion of creditors will someday wake up broke. Whether central banks will eventually try to monetize all bank debts is an open question, but such a policy would be reactive, not proactive, and it would take time to implement. In the meantime, you're stuck. In the direct lending scenario, moreover, you consciously decided to take the risk. You could have chosen to keep your money safe. Indeed, because the risks are crystal clear and honestly represented, many would have done just that. But that option does not exist as an institutional service today, because with fiat money, holding is losing, at least for all but the rare brief periods of deflation. So almost nobody does it. People keep their money in the bank and think it's the same thing as a bank keeping their money, but it isn't. To put it another way, the time-worn phrase, money in the bank, mostly means money not in the bank. If a depositor were to ask a bankrupt banker, "Where's my money?" the proper answer would be, "It's mostly gone." If you were to press on and ask, "What then do I own?" the banker would say, "A share claims to a bunch of IOUs." Deflation then simply makes manifest something that is already true. The money is gone, but the obligation to repay it disappears only when many borrowers can't pay. If a large portion of your bank's loans is tied up or becomes worthless, or your money claim is compromised, a bank failure simply means that the bank can no longer pay you back. The bottom line is that your money is only as safe as the bank's loans. In boom times, the banks become imprudent and lend to almost anyone. In busts, they can't get much of that money back due to widespread defaults. That is a rare thing, which is why deflation is a rare thing. If just a few more depositors than normal were to withdraw money, banks would have to sell some of their assets, depressing prices and stressing the viability of the enterprises behind the IOUs remaining in their portfolios. If enough depositors were to attempt simultaneous withdrawals, banks would have to refuse. Banks with the lowest liquidity ratios would be particularly susceptible to runs in a depression, and that is why banks fail. Now, you might be asking yourself, how can I protect myself against this? Are there any safe banks out there? Well, you can find those answers in Robert Prechter's New York Times bestseller book, Conquer the Crash. It also answers questions like, is my pension safe? What risk does my mortgage hold? Where can I find the safest money funds? Is my insurance with a weak company? Can I make money in a crash? And more. You can find a link to that book in this video's description, as well as links to resources that we think you might be interested in. Well, thank you for watching. If you like what you saw, be sure to like, subscribe, comment, share, and all that. I'm Greg Eident with Elliott Wave International. Until next time, have fun riding those waves.